For our final discussion on debt security markets, we investigate the risk and term structure of interest rates. The corresponding chapter in Mishkin is chapter 6. Term risk structure generally investigates yield differences of credit securities with the same maturity, which however are otherwise different. Say, the difference between the yield on a 10-year treasury bond and the yield on a 10-year bond issued by a corporation. The term structure, meanwhile, generally investigates yield differences of identical credit securities with different maturities. Think, for instance, of the difference between a 3-month T-bill rate and a 10-year treasury bond. Such yield differentials are also often referred to as yield spreads. Conceptually, we keep yield and term structures separate because different causes for why yield spreads exist are not clearly identifiable if we compare, say, a 3-month T-bill and a 25-year corporate bond. So we either compare across different issuers or we compare across different times. Starting with the risk structure of interest rates, we have 4 broad determinants of interest rates differentials, which between two bonds with the same maturity, for two bonds with the same maturity. These are default risk, which gives the risk structure its name, liquidity, income taxes, and informational or transactions cost. First, default describes a scenario in which a borrower refuses to or is unable to repay part or all of their outstanding debt. It is generally higher for corporate bonds than for most government bonds, since government can rely on future tax revenue for repayment, while corporations typically have to rely on more limited sales revenue streams. However, government can and has defaulted, although the US federal government never has in its history. Those governments who have a history of little or no default often serve as benchmarks for the price of risk. For instance, the difference between the commercial paper rate and the 3-month T-bill rate in the United States reflects the risk premium corporations pay on top of the US Treasury and borrowing short run. In this context, the 3-month T-bill rate is often referred to as the risk-free rate, and the difference is referred to as the risk premium. Now, graphically, we can illustrate why a risk premium exists using the previously discussed loanable funds model. Assume initially a very simple setup in which we have 2 completely identical bonds. Let's call one of them government and the other one corporate bond. If these bonds are really completely identical, both the supply and demand for loanable funds will initially be identical, and it will both pay the same equilibrium interest rates, I star G for the government bond and I star C for the corporate bond. Now say that the risk on the corporate bond increases, a case that reflects reality better. Corporations, as I just mentioned, are more likely to default than the US Treasury. Since these bonds are otherwise identical and risk is typically undesirable, demand for the corporate bond will fall, so the supply of loanable fund, supply of credit will shift to the left, while demand for the government bond, or the supply of credit to the government, will shift to the right. This drives a wedge between the two interest rates. I star C will increase, I star G will decrease, and this difference, this spread in interest rates, is what is referred to as the risk premium. Now, as you probably know, risk is a critical determinant of interest and plays an important role in pricing. Bonds like those issued by governments and corporations therefore are often rated, with Moody's and Standard & Poor's being the dominant rating agencies. There's others, but those two have about 85% market share. The third largest one is Fitch. You may be familiar with that one. Now, the ratings agencies are private entities within the market economy, and all of them use comparable letter ratings to rank borrower quality, with descending grades indicating a higher default risk. AAA to BAA for Moody's and AAA to BBB for S&P indicates relatively good borrowers, and those quality borrowers are often subsumed under the term investment grade. Everything below that is referred to often as junk bonds or high yield bonds. These are issues with significant default risk. Notice that the term high yield pays credit to what we've just discussed. Because these borrowers are riskier, they have to pay a higher yield on their bond. Now, in the private credit space, loans, mortgages, and so forth, credit scores, such as those issued by Equifax or Experian, fulfill a similar function to these bond ratings. As an example of the yield spread in practice, this chart lists the BofA, Bank of America, US BBB Corporate Effective Yield Index, the Bank of America High Yield Effective Yield Index, and the 10-year Treasury rate. The green line are high yield issuers, the blue line are BBB issuers, and the purple line is the interest paid by the Treasury. On average, the differential between the BBB and the 10-year is in the range of around 2 percentage points or 200 basis points. The spread to high-yield borrowers is higher and more volatile, typically closer to about 500 basis points, and has fluctuated more over time, in part due to certain sample coverage issues. Notice that in times of crisis, like the recession areas shaded in gray, Treasury yields tend to fall while corporate yields tend to rise. This is particularly elevated during the financial crisis of 2008, when the financial system was at risk of meltdown. High-yield bonds during this period traded at more than 4 times the cost of borrowing than government debt. This behavior is often referred to as flight to safety during a financial crash. What happens here is borrowers are trying to shed risk, and they instead buy safe US Treasuries. This drives down the yield on Treasuries, and it drives up the yield on other riskier assets. In the current context, we saw some flight to safety in March as the US economy went into lockdown, when corporate rates spiked briefly. But you'll notice that it's a much smaller stress period than we've seen in 2008, to a large degree thanks to Fed support of the corporate bonds market. The remaining 3 factors that determine interest rate spreads in the context of the risk structure are quickly covered. Liquidity generally, as you know, is desirable, and for that reason, out of 2 otherwise identical bonds, the more liquid one will be higher in demand and thus pay a lower interest. Less liquid bonds, in exchange, pay a liquidity premium. The most liquid market, generally speaking, is the US Treasury bonds market, which is widely available over the counter pretty much at any bank you can think of. Third factor are tax treatments, and historically different tax treatments across geographies can affect yields and demand for bonds. A very widely cited example is the US municipal bond market, because US municipal bond earnings are exempt from federal personal income taxes. So if, for instance, you hold a treasury bond, you have to pay taxes on any interest you might earn. If you own a municipal bond, such as one issued by the state of Washington, you would not. For this reason, municipal bonds have historically often paid lower interest rates than US Treasuries, despite the fact that they're less liquid and despite the fact that at least some of them have historically defaulted. They're not default risk-free. Final determination of rate spreads between bonds of different issuers are informational and transactions costs that you may incur when purchasing a bond. All else the same, such costs will raise the interest rate an issuer has to pay. This argument probably matters less in domestic bond pricing, but it does matter when you compare bonds across countries, which may not have the same disclosure standards, which may not have the same legal processes in dealing with default or similar, and it may therefore be more difficult for you to determine what a particular bond really pays.